Hello everyone, and a big welcome to RJ Sanderson TV for October. Another busy month and plenty to unpack on today's show. And of course, to do it all, I welcome Roy Sanderson. Roy, welcome. How's the month been?
Hello, Dave. Yeah, very good. We're into hay fever season. Busy time, end of this month. If you do your own tax return, you've got to lodge it or you get penalised. Or alternatively, go to an accounting firm and you get through till May next year, Dave.
Slightly warmer conditions and spring well and truly in the air. So it might be time to make changes. That's what people do in spring. They clean out everything at their house. They make changes, and one of them might be getting a tax agent, Roy. So rjsanderson.com.au if you want to do that. How's tax agent lodgements been over the last month? You're steady at the moment?
We're pretty steady. We're actually up on last year, interestingly, but the tax office have said they've issued around over $6 billion worth of refunds. So that's money that has come into the economy in the last 3 months. And we'll see a little later what effect that might be having on inflation.
Good tease there as we get into some of our slides for today. Kicking off with some tax tips, Roy, because I think that this one is a really interesting one for people who are working and are over 60. So kick us off with this one, Roy.
Yes, this is the sweet spot, Dave. If you're over 60, still working, you can withdraw your superannuation tax-free up to 10% of the balance. So if you have $400,000, you can withdraw $40,000. No tax payable on that. You can then deposit $40,000 into your superannuation depending on your caps that are available at the tax office. So this is a sweet spot because when you make the contribution, you get a tax deduction for it. So when it comes to you tax-free, when you put it back in, you get a tax deduction. I would strongly suggest you talk to an accountant and get some professional advice because we can work out what those caps are and what the tax benefit is. Over 60, still working, definitely the sweet spot.
Get some advice on that one, and which also takes us to the next one, Roy. What happens when women are out of the workforce sometimes is that their super balance lags behind their spouse. So I think this is or men for that matter, I should say, when a carer is out of the workforce. This is a really good one that helps incentivise people to make contributions to their spouse's account.
Yes, and if you've got a part-time worker or somebody earning under $37,000 in the family, make that deposit of $3,000, immediate 18% return, pumps your super up a little bit. That rebate of $540 phases out up to $40,000. So it's not well known. It's not taken advantage of as much as it should be. So certainly look at that as a possibility if you know that somebody in the household has an income of under $37,000 from wages, not all from interest and dividends, from wages.
I still think that's also it's a really important one, particularly for young people, because if you're having a family young, that the impact of those contributions to a spouse's super account can be transformational in retirement.
Huge benefits, huge, because they will earn interest, not only the $3,000 but also the $540. So the impact it can have when you finally get to retirement is just massive.
It's October 15, Roy, and can you believe it? We're about to say the C word live on TV. Christmas. It's coming up, and the bonus tax-free incentive is quite an interesting one and something to start planning for.
Yeah, I think Christmas comes along very quickly, and employers or maybe employees should start talking to their bosses and saying, hey, I have been told by my accountant that vouchers up to $2.99 are tax-free. Now, you can pick up a $250 voucher from Coles or Bunnings or Dan Murphy's, hand that to the staff or the worker, and there's no fringe benefits tax. The worker doesn't pay tax on that $250 or $299 if you can get it, and the boss doesn't have to pay superannuation or work cover. If you're going to give a Christmas bonus, a voucher is so much better than cash. So it's better for the employer and the employee. So look at the voucher scheme and make sure you get some advice. And you're allowed one voucher per staff member on your books. So think about that. That can be very attractive to your team members, depending on how many people you employ.
And to anyone listening, for me personally, Dan Murphy's over Bunnings, Roy. But that takes us to our next one, which is an important one about protection of assets. company directors really need to be aware of this situation because they can end up in a very sticky situation personally.
I'm sort of repeating this message because cyber security and cyber scams are becoming so much more common. We're seeing it almost on a daily, if not 3 or 4 a week. It's important that when you have a director who runs a company, which means PTI Ltd, the normal process is we tell the director your personal assets are protected. However, if you've failed to implement reasonable security measures for cyber security breaches, then your personal assets can be exposed. So there's some new rules on this that are not well known. I would suggest go to our website and go under the services tab and just look for some options that employers have. Don't just assume that I'll be okay, I won't get scammed, because if you do, your house, your family assets, your personal assets could be exposed.
And Roy, just on that, another incentive there, I'm guessing, is that the cost of the cybersecurity is tax deductible in most instances.
Yes, Dave. Any cost you spend in your business for cybersecurity protection is a tax deduction.
The next one that we've got relates to the construction industry and in particular long service leave, Roy.
Well, the numbers that the construction industry long service leave are suggesting of people who are not registered but should be registered are huge. They're like over 80%. So if you have people who work on any commercial, residential or house site, building site, we're not talking about the office worker or a manager that only works in the office, somebody who works on a building site, then you must be registered for them and contribute to Leave Plus at 2.7% of their ordinary wages. No, not based on overtime. And we've got some information sessions, Dave, to try and get some education out there to our clients and listeners. So 30th of October and the 10th of November, 2 options. Go to our website and register for those seminars. They're free, they're no charge. They're put on by the Construction Industry Long Service Leave and ourselves, RJS, as a way of just trying to educate our clients, because if you haven't been registered for a number of years, by law you actually have to back pay it, and the Construction Industry Long Service Leave will charge you interest. And we have negotiated an interest moratorium for our clients. So if you just want to put your head in the sand, now's the time to pull it out, because there are some benefits by getting it right. Yeah. You can't avoid it.
You'll get caught eventually, so make sure you jump online and visit rjsanderson.com.au and check out those webinars. Now, Roy, we've talked exotic fish, we've talked book week costumes, but you've got another crazy ATO deduction for us today, and this one relates to frequent flyer points. Taxpayer flying interstate for business at a cost of $2,000 decided to use Qantas frequent flyer points for the flight. Could they claim the value of $2,000 for the frequent flyer points they used?
Well, the reality is the client is convinced it's definitely business related. We're 100% certain that it was a $2,000 trip, but as soon as they converted to points, Qantas frequent flyer points, they cannot claim the $2,000. Unfortunately, this client attempted to claim the $2,000 even though they physically paid zero. They used their points. So the answer is no. If you use points, you cannot claim a tax deduction for the value of the points used.
Interesting. There you go. I think I'm looking forward already to our November edition to see what the last crazy tax deduction for the year is, Roy. Hey, you on this program have voiced your concerns about taxing unrealised gains on superannuation accounts. And guess what? The Treasurer has listened, Roy. Give us the update on super.
Yeah, this is breaking news. It has just come out. The Treasurer has said that the extra tax on super balances over $3 million, where they pay 30% instead of 15%, that $3 million will now be indexed. Because my beef was, not a lot of people today have $3 million in super, but in 20 years' time, most people will. So they're going to index it. So that's really good. And the other thing that I canvassed and pushed strongly for was to dump this idea that we would tax unrealised gains in super. If you haven't sold it, there's no profit. And they have now confirmed very recently that that will no longer be part of legislation. It has been dumped.
Well done, Roy. You are lobbying the right people, absolutely no doubt there. We're about to get into our analysis of some of the markets. So Roy, you wanted to just quickly make comment about this?
Yes, I'm about to mention specific shares, and I need to make sure people realise this is general advice. I'm not telling you what to do. Please hear what I've got to say, but go and talk to a registered financial planner. So my legal people are very happy that I've flashed up a general advice warning.
The ASX over the last 12 months, Roy, it's trended upwards, 8.2% return over the last year. Tell us about this rule of 72.
So the rule of 72 is that if you get a 7.2% return, your money, your asset will double in 10 years. Conversely, if you had a 10% return, your money, your asset base will double in 7.2% return. So you look at the Australian Stock Exchange 200 index, which is 200 shares, and you say they got an 8.2%, you would be high-fiving, wouldn't you, Dave? You'd be saying,
absolutely,
how good is this? I've got an 8.2% return because that's the average of those 200 stocks.
Well, I'm not sure you can do any better than that, can you, Roy?
Well, what if you got some advice and instead of buying 200 shares or the average of 200 shares, what if you bought some specific shares that are considered by wealth managers to be the best of the best? Now, these are in most good portfolios. I've just selected 10. You could pick the top 20 or the top 25 of the 200. Look at some of those returns. CBA at 22%, JB Hi-Fi 43%, Westpac 25%. These are awesome returns. The average across those 10 shares is 24%. So if this person was happy with 8.2%, the Australian Stock Exchange 200, the average, they could have got some specific advice, and if they just bought those 10 shares, they would have got 3 times the return. How good is that, Dave?
Very interesting. So I think the message is clear. Don't try and do it yourself. Visit rjsanderson.com.au and get some wealth management advice because, yeah, that's staggering. Three times the index.
And I want to reinforce, Dave, that is the message. Don't go out and do it yourself. Don't look at that 10 stocks, say, I'll go buy those. Get some advice. They will tell you what they think are the best 10 or the best 20 for the next 12 months. And it might not be, and it most likely will not be, just buying the average of 200, despite how good that looked.
Roy, we're changing our attention now to bank non-performing loans. We remember the subprime crisis of 2008. So this is an interesting index that we look at, or this is an interesting rate that we start to look at. Have a look there, just between sort of 2008 and 2009, where 2.5% of loans were non-performing. And what happened? We saw the economy absolutely crash and tank, and it was quite a big landmark event globally. So you wanted to make mention of this one.
Yeah, I did, because Dave, I've circled that little part because in the last month it just levelled out, which I think is really important, because if that keeps going up towards the 1.5% of loans and above that, I think we start to have a little bit of a crisis on the horizon. Often when banks have non-performing loans, that's a little bit of an early indicator of how the economy is going and how businesses and individuals are coping within the economy. So I was very pleased this month to see that levelled out a little bit. It is something we will watch, and it will be interesting to see where that goes over the Christmas break. Yeah,
agree. I think that's a big watch, and keep an eye on that over the next few months. I think it's something to keep a very close eye on. One index or one rate that people are often keeping a close eye on is the inflation rate. And Roy, you mentioned $6 billion pumped back into the economy after tax returns lodged since July 1. Have a look what's happened.
I do think that's one of the reasons inflation unexpectedly jumped up, which is disappointing. It's a reason we didn't have an interest rate reduction very recently. This is a little bit of a concern. Part of the inflation rate is the cost of power, electricity, and that went up 24%. So that is a worry, but it is pushing inflation up.
It's also a key measure when talking about the interest rate, Roy. We saw rates put on hold at the last meeting, and you've got some interesting forecasts there from each of the big four.
Yeah, it looks like CBA, NAB and ANZ are saying there's only going to be one decrease next year. February and May are the predictions, where Westpac are out on their own saying we'll have 3 increases. They're three banks are saying it's going to settle at 3.35%. Currently, we're at 3.6%. I would love to see what we had between 2016 and 2019, where it didn't move for about 3.5 years. And I think that gives the economy and the public consistency. We know what the rate is, and I would be keen to see it levelled out for quite some time. My prediction is that we will get down to between 2.5% and 3%. And I am a little bit on Westpac's side, and I know it's all driven by inflation and a few other employment factors, but I think we're going to see 3 reductions in 2026. I don't think we'll see one on Melbourne Cup Day, and I don't think we'll see one in December, and I think the first rate reduction will most likely be February. Of course, these are just estimates, and these are based on what stats we have available today. I can tell you if inflation continues to go up, we will not see a rate reduction. So there are a fair bit of things to go under the, water to go under the bridge before we know exactly what's going to happen with inflation, with interest rates.
I think it's an interesting one, Roy, because those forecasts you showed have changed. I think the banks have changed their position, and people have changed their position because we sort of all expected it to continue to fall. And now they're sort of saying, hey, maybe it might level out at 3.5% or around that mark, or 3.35%. And guess what that's done? It's caused some fear in the economy, Roy, because as we look at consumer confidence, you can see that it's declined 6.5% over the last couple of months. And you can see that, and the Westpac index actually breaks it down and attributes the reason that it's because of this rising rate of inflation that people have been spooked by the prospect that their mortgage rates are going to remain at a level that they currently are or thereabouts. So it's certainly having an impact on consumers in the economy.
There's a wild card here, Dave, that I might throw out there. What impact has the Trump measures taken in relation to inflation yet? Have we seen any inflationary effect?
It's a good question. So you're obviously referring to some of these tariffs. I think mainly from what I've observed, the effect of that has been more around markets at the moment. People still trying to work out what the regulatory position is on imports and exports, but certainly over the course of time, we may see that. You mentioned energy as one that has spiked. We may see that with other commodities in particular, and if the price of commodities goes up, then of course the price of material goods will go up as businesses' costs increase. So I think that's a watch this space, and particularly if we see some of those tariffs implemented on local goods that are being exported, we may also see some differences in their local pricing models as well. So I think that's a watch this space.
Yes, I think it's a real fear factor because in economics, generally tariffs will mean inflation goes up. And if inflation goes up, interest rates won't come down. And I agree. I think it's a little bit of a worry where the market might go with those policies right now.
Turning our attention to property, and we kick off with the home value index. Roy, what are the takeaways from this one?
Yeah, takeaways are that house prices are going up. 12.9% in Darwin. Go Darwin. Brisbane has certainly jumped up. Melbourne languishing behind every other state at 1.9%, possibly because of compliance costs from the state government and land tax. So just thought I'd share that there is price growth. It's just not as strong in Melbourne right at the moment.
Price growth, and there is rental growth as well as vacancy rates drop. That would make sense, Roy. It's a supply and demand thing. There's less supply, so therefore the cost of renting is going to go up. Yep. Vacancies
going down. That little where I put the circle, they've just crossed. This will force rents to go up because there's less vacant properties. So this is a little bit of a worry.
It's a pretty interesting graph. If we just go back one there again, we want to make mention of the point that there are only 3 intersections on that graph, and this is one of them. So in the last 10 years, we've only seen this trend reverse 3 times. So it's quite as you say, quite an important moment to recognise where growth has outpaced vacancies.
Yeah, and if we were to go back to May 2021, where they did cross previously, the pressure on rents was extreme. Rents were going up considerably quickly.
The next one, as we just flashed to before, is the change in rents. Roy, talk us through this one.
Yeah, so Melbourne's rent growth is only 1.4%. So if you are a renter and you're about to negotiate a new rent arrangement, tough luck if you're in Darwin, because rents are going up around the 7% mark. Brisbane over 5%, but in Melbourne 1.4%.
The next one is an interesting one, Roy, and one that you've plucked that you wanted to talk to about wage price and I suppose the lack of wage growth over the last 15 years.
Yeah, it's interesting because all of us want to go to the boss and ask for a pay rise. Wage growth has been relatively low, and I'm the one who's put that red line in to try and pick where the sort of average is. But right at the moment, it's sitting at under 3.5%. So if you go to the boss and say, hey, I want a 5% increase, you've really got to have some other reason, education, productivity. It won't just be because of wages have gone up across the board. Often wage growth, Dave, is linked to the inflation rate. And we saw that our inflation rate is around 3%. So wages often is very, very closely tied to that rate.
I suppose the good news is, though, Roy, that the tax rates are changing, so that will mean a little bit extra for workers in the pocket from July 26.
Yes, if I was to show a graph over the last 10 years, we would see that taxes for personal income tax has reduced quite a bit. We still have another 1% band for the next 3 years for any income earnings between 18 to 18,200 and 45,000. So they're dropping 1% over the next 3 years. And that does sort of tamper a little bit the wages growth number, because we are getting more in the pocket because our tax rates are reducing. Not by much, I might say, and I think there's room for them to go up to reduce a lot more.
There you go. Well, that rounds out all of the chat on the economy. We hope you've got a pretty clear picture of things economically, and then also pertaining to the stock market and to property. The one message, though, throughout all of this is clear. It's general advice. Make sure you visit rjsanderson.com.au and get in touch with the professionals, because they will help you out, and they are a great team there at RJ Sanderson. And they're there to answer questions like this, like have been sent in from our first viewer. And this is a classic. I love this one. I'm a tradie and want to claim a dog to guard my tools at home. Is a security dog tax deductible, and would the cost of food and vet bills and all of the associated running costs of the security dog be tax deductible as well?
So, Dave, our first question is it a personal cost or is it really a work cost? Yes, you have tools at home, but also you may have family and you've got the rest of the house. The answer is generally when there's a guard dog at home, it's not a tax deduction. The tax office have made that very, very clear. The default is it's personal. But it is possible for a dog to be tax deductible. You may house a dog at a factory that lives at the factory. It's behind fences. And if it lives at the factory and it's there to guard the factory, it can be a tax deduction. The vet bills, the food bills, etc. But if it's a home dog, no, it's not likely to be a tax deduction.
Wow. There you go. So if it's at the factory, you may have a chance.
Yes.
And it may be a better security guard than a person as well, you know.
Correct.
To get the right dog. Now, I'm just going to double down on this, Roy. What if the dog at home is not very pattable and not very fluffy and clearly very, very aggro and security-like?
Well, the default at the tax office is that that's still protecting the house, not necessarily just the tools.
There you go. Well, factory, yes. House, no. The next one that I like as well, as a spectacles wearer, I work from home and use the computer all day. I need reading glasses to see my work. Can I claim the reading glasses as a tax deduction?
Now, I'm in the same boat as you, Dave, and I believe these should be tax deductible. However, the tax office have ruled that reading glasses are classed as a medical issue, and therefore reading glasses are not a tax deduction. This is something the government should look at changing, because I think they should be tax deductible.
Well, you've got the ear of the treasurer. Now, you can pitch this one in, Roy, as well. Work from home glasses, I agree. I'm in full support of that. The last one relates to cars and electric cars. Talk us through this one, Roy.
Yeah, so this came throughout the month. The person is using their car for logbook. We don't for work. We have no doubt as to that. It is an electric car, and they asked the question. They're not paying for fuel, so they charge their car twice a week. How do they claim the fuel or the electricity in this case, because it's an electric car? So the tax office have given us a rate. It's 4.2 cents per kilometre that you've travelled. In this client's situation, they're claiming 91%, so it's 4.2 cents by kilometres done for the year by 91%, and that covers your house power.
There you go. Roy, question without notice relating to cars. If you have a novated lease with your employer, can you claim running costs on top of that, or is the sort of tax using the pre-tax money effectively your deduction?
So the answer is you cannot claim those costs. It's a novated lease. The employer is paying those. You've already got the pre-tax benefit, so you don't then double up and try and claim the costs on your personal tax return.
There you go. Makes sense. Roy, finish us off with Roy's Rage, because this is another segment that they all watch. What have you got for us for this one?
Well, I'm a little annoyed that we have just had a report released by the ATO which says that we have a number of large companies in Australia with huge turnovers or sales. AGL Energy, they sell $12.8 billion and they pay no tax. No tax. And if you look at the cost of energy, you've got Energy Australia on the list, $7 billion, they pay no tax. With the cost of energy, where are the profits going and why are there no profits? Australia Post, what sort of business are you running if you have sales of $9.3 billion, no profit and therefore no tax paid? And just run through the list. You know, General Motors and Fujitsu at the bottom there, still $2 billion worth of sales and $1 billion for Fujitsu. Where are the profits going? I'm sure it's somewhere. It's not Australia. And I think it's time the government step in here and do some investigation as to why these companies can be so large, have such high level of sales and pay no tax. It's annoying for all of us Australians who pay their right share and their right hit of tax.
Whack. We know that you've put this one on the agenda in the past, and I'm sure that the government will be listening to this. So another strong message from you, Roy. That's everything we've got time for on the October edition. Any predictions for our final show in November, Roy?
Well, we're going to have to do something different because it's the last one of the year. We're not yet sure whether we're going to do this for 2026. So if you like the show, maybe send us an email in support and say we should keep it going. If you don't like the show, send us an email and say it's time to can it. But yeah, we're in discussions for next year, and we're making a decision after the next show whether we want to go on and do this continue. We've been doing this for how many years, Dave?
It's our 6th year, Roy.
6 years. There you go.
That's
so hopefully we're back next year.
I don't see many shows on Netflix that have season 6. So we've done very well, I think, to get this far. You've been brilliant today, as always, Roy, and well done on getting the government to change the super regulations and the proposed super tax. Thanks to everyone for jumping on and watching us today. We'll see you again in November.